The numbers we're looking at today aren't forecasts or predictions. These are confirmed closing prices from trading sessions that have just ended. And folks, what we're seeing is something truly remarkable. Silver just blew past $81 an ounce on the COMEX. But here's the kicker, it didn't get there slowly. This wasn't some gradual, orderly climb built on weeks of steady gains. No, this was an abrupt, explosive move. What we witnessed today doesn't look like normal price discovery at all. It doesn't resemble buyers and sellers calmly meeting in the middle to find a fair price. This looks like a market under extreme stress. It's what happens when a system starts to break down because liquidity is vanishing. But hold on, because the most important signal isn't the number you see flashing on your screen in the West. The really critical development, the one that changes everything, came from Shanghai. The Shanghai Gold Exchange closed silver near its highs for the day. The TD contract printed a price of 19,495 yuan per kilogram. That's a jump of more than 7% in a single trading session. Now, let's do the math. When you convert that price at current exchange rates, it comes out to roughly $88 to $89 per ounce. Let that sink in for a moment. While Western markets are celebrating silver breaking above $80, the East is sending a completely different message. Shanghai is essentially screaming that Western prices are still way too low. In the plainest terms possible, Shanghai is saying the price is wrong. This massive divergence isn't just a blip on the radar, it signals the beginning of a brand new market regime. The old rules that governed the markets for the past decade, you can throw them out the window. They no longer apply. The signs are impossible to ignore. We're seeing single-day moves of 5 to 7% becoming the new norm. We're seeing persistent price differences, or spreads, between regions of $8 to $15 an ounce. And the premiums you pay for physical metal, they're not shrinking back to normal. They're expanding. This is not just normal volatility. This is not just a market having a busy day. What we are witnessing is deep, structural stress in the global financial system. The foundations are shaking, and the price of silver is one of the first and clearest indicators that a major shift is underway. Keep your eyes on Shanghai, because that's where the future of this market is being written. Thanks for watching. Don't forget to like and subscribe for more updates. Did silver just teleport higher? It might look like it, but what we just saw was no accident. This was a classic liquidity vacuum in action. Let me break it down for you. In a normal, healthy market, you have sellers ready to go at pretty much every price level. So, as buyers come in, the price ticks up gradually, step by step, as that supply gets absorbed. It's a smooth climb. But when a market gets stressed, something changes. The sellers get nervous and pull back. People holding inventory decide to wait on the sidelines. Suddenly, all that liquidity, all those ready sellers, just disappears. So what happens next? The buyers don't stop. They hit the order book, looking to buy, but there's no one there at the current price. Price can't just climb smoothly anymore. It has to leap, or gap, higher to find the next person actually willing to sell their silver. And that's exactly why we saw silver jump 5 or 6% in a single day. It wasn't because everyone suddenly got super bullish overnight. It was because the supply at the old prices simply vanished. These dramatic moves don't just happen in a bubble. A liquidity vacuum rally like this typically happens when one of two powerful forces, or sometimes both, are at play. The first is a systemic, macro-level rush into hard assets. Think of it as big money looking for a safe haven. The second is arbitrage pressure, where traders try to profit from different prices for the same thing in different parts of the world. And guess what? Right now, both of these forces are firing on all cylinders. Let's look at what's happening in places like Shanghai. That's a physical delivery market, and it's under serious strain. When a global commodity like silver starts trading at significantly different prices in different locations, arbitrage capital swoops in. These traders don't care about your chart patterns or technical indicators. All they see is a price spread they can profit from, and they act to force those prices back together. This is how you get a two-price system. On one hand, you have the screen price that's the price you see on futures markets and spot benchmarks. On the other hand, you have the acquisition price that's what it actually costs to get your hands on the real, physical metal. In calm, normal times, these two prices are almost identical. But in stressed markets, they start to diverge. That growing gap between the paper price and the physical price is a huge warning signal from the market. When physical silver consistently trades at a premium over the paper price, the market starts treating them as two completely different assets. It's a fundamental shift. And when that happens, the repricing isn't smooth, it's violent. You see those huge price gaps we talked about. You see margin shocks that force traders out of their positions. You see forced liquidations, and you see people hoarding whatever inventory they can get. At this point, buying isn't a choice anymore. It becomes mechanical. This is why what some people call panic buying isn't really emotional at all, it's completely rational. Think about it. An industrial user who needs silver for their products can't just shut down their factory. A short seller facing a massive margin call can't just ignore it. A hedger who has a contract to deliver physical silver can't just breach that contract. When all these different players are forced to buy at the exact same time, demand completely overwhelms the available supply. That is the powerful mechanism that is in motion right now. It's not about sentiment. It's about supply, demand, and the very structure of the market breaking down under pressure. It's a fascinating and critical time for silver. Thanks for watching, and if you found this breakdown helpful, make sure to like and subscribe for more deep dives into the markets. See you next time. Have you seen the price of silver lately? It's not just another blip on the chart. What we're witnessing is a fundamental shift, a tectonic repricing of one of the world's most critical assets. This move didn't just appear out of thin air. In 2025, silver skyrocketed by an astonishing 147%. This wasn't some speculative frenzy, it was a structural repricing, a wake-up call to the world. We're living in an era where the very foundation of our financial system is being questioned. Currency credibility is eroding day by day. Central banks are caught in an impossible situation, trapped between runaway inflation on one side and mountains of debt on the other. Their only tool seems to be monetary debasement, which essentially means your money is worth less and less. Add to this a volatile geopolitical landscape where nations are scrambling to secure vital resources, and you have a perfect storm. Capital is flowing towards safety and security, and silver stands right at the crossroads of this chaos. Why silver? Because it's unique. It's a dual-purpose asset. For thousands of years, it has been recognized as real money, a store of value when fiat currencies fail. But it's also an irreplaceable industrial metal. Your phone, your car, solar panels, medical equipment, they all need silver. It's a critical input for our modern tech-driven world. So, what happens when the overwhelming need for a safe monetary asset collides with an unyielding industrial demand? You get explosive price discovery. This isn't just a number on a screen going up. It's a battle for physical metal playing out on a global scale. The market is trying to figure out what silver is truly worth in a world that's rapidly changing. We're not just watching a commodity rally, we're watching the financial system itself being stress-tested in real time. This isn't about day trading or quick profits. This is about understanding the massive structural forces reshaping our world and positioning yourself for what comes next. To really grasp where silver is headed, you can't just look at the headline price on your screen. You need to look deeper, at the structural signals that reveal the true state of the market. There are 3 key indicators I'm watching closely, and you should too. First, and most importantly, is the Shanghai premium. The market is not clearing. It's a glaring sign of a physical shortage that the paper markets are trying to ignore. If you see the spot price rising, but at the same time, those dealer premiums are also expanding, that's a huge red flag. When you see this happen alongside reports of shipping delays or certain products being out of stock, you know the physical squeeze is real. It's not about speculation anymore. It's about a desperate scramble for physical metal. It means the paper price is becoming disconnected from the reality on the ground. The third and final signal is a bit more complex but incredibly powerful. Volatility combined with forced flows. In financial markets, you have different types of players. You have those who are short silver, betting the price will go down. You have producers, or hedgers, who use futures contracts to lock in prices. And you have large, systematic trend-following funds, which are basically algorithms programmed to buy when prices are rising. When you get a powerful upward move in silver, it creates a cascade of forced buying. The shorts have to cover their positions, meaning they are forced to buy, pushing the price even higher. Hedgers might need to buy back their positions. And the trend-following funds, This creates a massive arbitrage gap, a disconnect that the market will have to resolve. For this spread between the East and West to close, one of two things must happen. Option 1. Chinese demand collapses completely, bringing the Shanghai price back down to meet the Western price. Given the strategic importance of silver for their industrial and monetary goals, how likely do you think that is? Option 2. The Western paper price is forced to rocket upwards to meet the physical reality being set in the East. This seems like the path of least resistance. The paper market can't ignore a physical shortage forever. At some point, the dam has to break. The price discovery mechanism is broken, and it's being reset by physical demand from the other side of the world. We are in the middle of a historic repricing event. The final, and perhaps most important, question is not whether the prices will converge, but how. A violent convergence could look like a limit-up day on the COMEX, where the price jumps so much, so fast, that trading is halted. It could look like a default on the exchange, where there simply isn't enough physical metal to deliver against all the paper claims. We could see a period of extreme volatility where the price of silver becomes untethered from any historical precedent. We are in uncharted territory. The signals are clear, the physical market is in control, and the East is leading the way. The only question left is how dramatic the final repricing will be. Keep your eyes on those signals: the Shanghai premium, physical availability, and the forced buying flows. They will tell you everything you need to know about what comes next. Thanks for watching, and if you found this analysis helpful, make sure to like, subscribe, and hit the notification bell so you don't miss our next update.